In West Virginia, in terms of all the taxes, if you were to ask economists, all taxes have an impact on the economy, different degrees and whatever, but the tax that probably has the least impact on economic activity from a negative standpoint, most neutral, is probably the real estate taxes. And in West Virginia, we rely less on real estate taxes than our neighboring states, and therefore we have to make it up by relying on other types of taxes. But we also have to be cognizant of personal income tax rates in our surrounding states, as well as sales tax rates in our surrounding states. And to the extent that we're out of line with surrounding states, they will take advantage of us and have in the past. So I just bring that to your attention. Today, a few weeks ago, we looked at the property tax in full. Today, we're looking at the income tax, starting off with the individual income tax. And the individual income tax in West Virginia, last fiscal year, it generated more than $1.9 billion. For simplicity purposes, so we don't have a full employment act for tax practitioners and they can afford to come to the tax meeting here, we tend to tie into the federal code for definitions, and most states do. West Virginia's tie into the definition of income is federal adjusted gross income. As reported on line 37 of the 1040, and incorporated in the definition of personal income, in addition to your total additions of income, is a number of different expenses that West Virginia ties into, such as health savings accounts, the deductible portion of self-employment tax, the self-employed health insurance deduction, certainly IRA, modification student loan interest, certain tuition and fees that are allowed as a deduction on the federal return, and a couple other modifications. But we tie in there. Last year we have complete data available at both the federal and state level. Is tax year 2012, and in 2012 there were $36.6 billion reported on the full year resident returns that were filed in West Virginia. There were 762,000 full-year resident returns filed. In addition, there were another 69,000 part-year residents or non-resident returns filed in the state. Now, West Virginia is actually in the majority. There's 29 states and the District of Columbia use federal adjusted gross income as their starting point. Another 7 states use federal taxable income for the link. There are 5 states that create their own definitions of income, which creates more opportunities for tax practitioner employment, I suppose, but they're a little different. Alabama, Arkansas, Mississippi, New Jersey, and our neighboring state of Pennsylvania has its own definitions. Interesting enough, there are 0 states that start with federal tax liability, and I believe when the modern day personal income tax was first established back around 1961, initially we went with federal tax liability as a basis, and when I first started working for West Virginia Revenue over 30 years ago, there were 4 or 5 states that started with federal tax liability, but the problem with federal tax liability is that Congress likes to change the tax code often. And because of such changes and trying to keep up with them or became problematic for state finances, virtually all states have moved away from federal tax liability as a starting point. There are 2 states that have a limited tax on interest and dividends, New Hampshire and Tennessee, and then there are 7 states with no personal income tax. Now, on the West Virginia tax return, we start with the federal AGI. We add certain items to the income, such as certain interest or dividends that may be exempt from federal tax but not state tax. Interest and dividend income on non-West Virginia state and local bonds. That is, if you have government bonds for West Virginia, they're exempt, but if you have government bonds through Kentucky or one of our neighboring states, they're not. And the majority of states actually treat it this way. Although there are a couple that exempt all state and local bond interest regardless of where it comes from. So one of those would be Utah. Qualifying 402E lump sum distributions, those are taxed on a special form, federal form, I believe it's 4972. But we pick up as an add back to the state because it's not in federal adjusted gross income. So in order to tax that income, it's an add back. We also add back Section 199 deduction for U.S. production activities. Now, in most cases, West Virginia complies with all the federal definitions. This is one that we do not comply with, and probably somewhere around half the states are in the same boat as West Virginia, do not comply with that particular deduction. We'll talk about a little bit later during the corporate next section. But the federal return statistics that there was about $21.7 million added back for West Virginia on about 1,340 returns. And then withdrawals from a prepaid tuition trust or Smart 529 savings plan. It's not used for qualifying expenses. When I have that urge to go to Hawaii on vacation and I don't have the means to do so, and I said, well, let's take some money out of my son's prepaid tuition plan, you have to add it back, and we tax it. So it becomes a net back. Not too many folks do that, but about $600,000 though were added back. So it tells me that a few folks take that trip to Hawaii and borrow from certain funds. Decrease in modifications, total about $1.4 billion subtracted on West Virginia returns. And these generally summed up by U.S. obligation interest and dividends that are required to be exempt from state tax due to federal law, as well as certain West Virginia obligations that may be subject to federal tax, but we exempt them from state tax. There's an accounting adjustment for refunds of state and local income taxes that are reported on the federal return. If you itemize for federal tax purposes, you take a deduction for income taxes, but you got a refund from the state of West Virginia. That refund the following year has to be stated as income on the federal return. This simply takes it back out again. There's a federal requirement that states do not tax income from the Railroad Retirement Board. Those may be pension benefits, they may be unemployment benefits. But under federal law, you're not allowed to tax those, so those come out for state tax purposes. Contributions to the West Virginia prepaid tuition program, which is now a closed program, so probably not too much in the way of contributions still going into that program. And then the Smart 529 savings plan. Also, for folks that purchase long-term care insurance, there's a deduction on the state tax return for those premiums. There's a modification on the state tax return for state medical savings accounts up to $2,000. This was created probably at least 25 years ago, prior to the establishment of federal modifications of similar type. I'm not aware, I could be wrong, but I'm not aware that there's ever been a state medical savings account set up in a situation where it's taxable at the federal level and exempt from the state level. So I can't fully prove it, but I've never seen that modification legitimately claimed on a state tax return. So it's old code that's still there. There's an Easy Pass toll fees. A few years ago, the toll on the West Virginia Parkway was increased, and the state created a decrease in modification equal to the amount that you pay for the Easy Pass toll fees. In order to take that modification, this has to be at least $25, but not more than $1,200 per individual. Recently, not too many years ago, there was an autism trust fund set up in the state code, and contributions that are made to qualified trust funds up to a maximum of $1,000 for an individual, $2,000 for a joint return may be deductible. Not many claim that. That's very small. And then finally, this is also fairly recent, at least the first part, active duty military pay during the year of separation from active service. And then as well as active duty National Guard or Armed Forces reserve pay due to executive order of President in Operation Enduring Freedom or for domestic security. So that's a somewhat limited modification. There are a number of what I call pension modifications, and I need to back up a little bit. And prior to 1987, in the old code where West Virginia used to have tax rates that went up to about 15% or more, we had itemized deductions and a whole bunch of other provisions. We used to exempt certain state retirement plans, benefits, as well as certain local retirement plans. Not all local retirement plans, not all state retirement plans. These are all government plans, not private sector, from state income taxes. And that exemption extended to the West Virginia Police. Deputy sheriffs did not exist back then, but the state and local police, as well as benefits received under the military service, teachers retirement system, and public employee retirement system. We did not provide for any type of reduction for federal civil service. In the Tax Reform Act of 1987, the initial draft, and this was put together basically on day 60 of the legislative session. The initial draft, which basically was designed to broaden the base and lower the tax rates, required that all of these pension benefits be reduced to $2,000. Again, federal civil service was not part of the equation. However, in the final draft that emerged, retained a full exemption for West Virginia State Police and local police and firemen. And as a result of that, the state of West Virginia has had significant amounts of litigation over time because everybody would like to be a policeman or a fireman when they retire. They get a little bit better pension benefit than other folks. Shortly thereafter, in 1989, there was a U.S. Supreme Court case called Davis v. Michigan that came out, where the federal Supreme Court says you state governments, a number of state governments, discriminated against federal retirees. That is, state government retirees got to a pension exclusion, federal government retirees did not. Basically said you have to treat the federal folks at least the same as the state folks. So you can treat them better than state folks, but you have to at least treat them the same. That cost the state of West Virginia some significant refunds, mainly related to 1985 and 86, but it saved us on 1987 and 88 because of the $2,000 limitation for other public sector retirement benefits. Again, these are limited to certain types of public sector retirement. If you're a college professor and you participate in their plan, that's not in the list here. There's a few other retirement systems not on the list, but it's one that creates controversy because everybody likes to be a fireman or policeman if they can. A few years, probably more than a few years ago, the legislature decided to increase the modification for military retirement benefits only from $2,000 up to an additional $20,000. So the military folks who are retired now get a $22,000 modification, which is a little higher than everyone else. And interesting enough, there's a lot of other public sector folks that would like to be military retirees, even though they're not military retirees. Again, a little bit of conflict there. Now, all of these retirement benefits that are deducted count against what is referred to as a senior citizen or permanently disabled modification. That is anybody that's 65 and older and or permanently disabled, and I'm not sure how many states have a permanently disabled version, but West Virginia does. You get a modification of up to $8,000 regardless of source of income. If you're single, and up to $16,000 on a married return, but both spouses have to have at least $8,000. This provision was likely borrowed from the state of Maryland when it was enacted back in the early 70s. Probably the most expensive portion of the modifications, in excess of $50 million a year, due to the $8,000, $16,000 modification. I might note that the trend in states has been to try to move away from pension modifications because states are now realizing that there's a lot of older Americans out there and the population is increasing. So a number of states have moved somewhat away from fully exempting pensioners, including the state of Michigan, which has made some efforts to scale back on its full exclusion that it used to offer that was subject to the Davis v. Michigan litigation. Of our neighboring states, Virginia and Ohio, for the most part, do not allow such modifications. Maryland, it's a restricted modification, a little bit more lucrative for military. In Kentucky, it's a broad modification for all types of retirement income, both private and personal, or private and public sector, but it's limited to somewhere around 40-some thousand. And in Pennsylvania, all retirement is exempt from tax, but Pennsylvania is different. Pennsylvania does not recognize deferred income. So if you're contributing to a 401k plan or an IRA, for Pennsylvania, you have to pay taxes up front. They are what I would call the Roth IRA state. So they're a little different in that regard. States tend to act a whole lot alike, and West Virginia back in 1987 joined most of its neighboring states, particularly the ones to the north, in eliminating itemized deductions. And there's a bunch of states that have eliminated itemized deductions on the income tax return. States that have eliminated itemized deductions tend to have lower individual income tax rates than other states. And a number of the states, not all of them, but a number of them also have a flat tax rate. There's a flat tax rate in Michigan, Illinois, Indiana, certainly Pennsylvania has a flat income tax rate. New Jersey used to have a flat income tax rate. They no longer do. And I believe in Massachusetts has a flat income tax rate. In the determination of the West Virginia tax, we ultimately have about $32.1 billion in West Virginia taxable income on the resident return in 2012, and about $1.6 billion in pre-credit tax due. So that equates out to an average tax rate of roughly 5%, a little bit, maybe just a tad less than 5%, but right at roughly 5%. And how you calculate that is you take your federal adjusted gross income, you add your increase in modifications, you subtract your decrease in modifications, that gets you West Virginia adjusted gross income. And then taxable income is derived by taking West Virginia adjusted gross income and subtracting out your personal exemption allowances. In West Virginia, the allowance is $2,000 per exemption on the federal return, plus an additional $2,000 for a surviving spouse for a limited period of 2 years. If your federal exemption number on the federal return is 0, you get a $500 allowance for a dependent type tax return. And then there's also what is called a low income earned income exclusion. If your adjusted gross income is at or below $10,000, if you're single or joint, if married, found separate under $5,000, and to the extent that's wage and salary income, you can deduct it all off. So that gets you the West Virginia taxable income. The West Virginia tax is taken by applying the tax rates, which are graduated to the West Virginia taxable income. And those rates currently range from 3% on the first $10,000 of taxable income to a maximum of 6.5% on income above $60,000. Married, found separate folks have their income brackets are cut in half. That's West Virginia taxable income. In terms of top tax marginal tax rates, you'll notice that the states that are in purple tend to be the ones, not all of them, but most of them tend to be ones, at least in the eastern parts of the United States, tend to be ones that have no itemized deductions. Again, broader tax base means you can have a lower tax rate, and that exists in Michigan and Illinois and Indiana as well as Pennsylvania. West Virginia is sort of in the middle of the pack because we have a graduated rate structure in one of the green states. And then some of the higher tax states, the ones over 8%, include the most populous states of California, New York, Oregon, because Oregon doesn't have a sales tax, does it? Minnesota has a very narrow sales tax. They have high income tax rates. Iowa has fairly high income tax rates, along with Vermont. So just an overview of the comparative tax rates on the top marginal rate by state. Now, in the determination of state tax liability, we have to take out some tax credits. And these tax credits include the credit for income taxes paid to other states. That's a normal feature of an income tax structure. All states have it. In 2012 was about $20.6 million for 7,400 resident returns. West Virginia and its surrounding states have an agreement with each other that if you as a resident work in one of the surrounding states, you will not be taxed in that state at the state income level. You'll be taxed in your home state. It's a reciprocal agreement. So folks that live in Ohio or Pennsylvania or Maryland or Virginia, Kentucky, if they work in West Virginia, they still get taxed in their home state. If vice versa, if West Virginia residents work in one of the surrounding states, that's particularly useful for the Eastern Panhandle, where a lot of folks work in Maryland or Virginia. You pay tax in West Virginia, you don't have to worry about the Maryland tax or the Virginia tax. Now, if you happen to be from North Carolina or some state beyond our surrounding states and you work in West Virginia, you are subject to our income tax to the extent you work here. So that eases up some of the burden on the multi-state level where folks may work in more than one state, at least the ones that are surrounding West Virginia. We have a number of low-income relief tax credits. The family tax credit, which basically eliminates tax liability for anybody at or below the federal poverty guideline. About 90,000 tax returns, $17.6 million in claims. There's a senior citizen homestead credit, which applies not only to senior citizens, but also those folks who are permanently disabled. And West Virginia has more than its share of permanently disabled residents. They get a refund on any local tax that they pay up to the first up to the amount of tax on the first $20,000 of taxable valuation. That's after the local homestead exemption, which means that there's no tax on any home that's assessed at $40,000 or less, at least for lower income folks. Low income is someone whose adjusted gross income is at or below 150% of the federal poverty guideline. And around 55,000 claims in 2012, $10.8 million. A few years ago, the state also created what is called the Homestead Excess Property Tax Credit. If anyone has a property tax bill that's greater than 4% of their adjusted gross income, and their total adjusted gross income is at or below, 300% of the federal poverty guideline, they can get a refundable tax credit equal to the difference between the amount of tax that they paid at the local level on their residence and the and 4%, or up to $1,000. There were about 7,100 claims, $2.9 million in tax liability. Sometimes with some of these claims are not what they should be. We've had run into people that make claims for commercial property or class 3, class 4 property. And in a couple cases I've seen where folks paid 2 years worth of tax in 1 year in order to get the refundable credit. So there's a little bit of gaming in that, but not a whole lot of claims there because we have a very low residential property tax, basically for folks that have a lot of house relative to their income. Other credits that are out there, there's an adoption credit. It used to be called a non-family adoption credit. In recent years, it was expanded a little bit to include certain family members. $1.2 million was the total claimed in 2012. Neighborhood investment, that's a charitable giving program that gives you a 50% tax credit for those who contribute to a charity that has one of those that qualifies under that program. And in 2012 it was about $2.2 million on 1,900 tax returns. The alternative fuel motor vehicle tax credit, which has an asterisk next to it, that was by far the largest tax credit on the individual tax return in 2012. $32.4 million on that year's return alone, 9,350 claims. That credit was since, for the most part, sunsetted by the legislature. Not completely sunsetted, but about 95 to 97% of the credit benefits were sunsetted in 2013. And actually, last fiscal year, we had revenue growth for a change of about 3.6%. Personal income tax went up over 10%. Part of the reason why the income tax rebounded last fiscal year had to do with the elimination of the alternative fuel motor vehicle credit. Apprenticeship training is a program that provides a tax credit to employers who have an apprenticeship training program. It's a fairly small credit, about $300,000. There are two types of rehabilitative building credits. One is a commercial credit where you get 10% a credit based on it's a federal program that the state ties into on a qualified commercial building. And then there's a residential rehabilitation credit that's a 20% credit that can apply on the resident side. That's about $700,000 in 2012. Those credits are transferable, so there are folks who may not have tax liability that oftentimes will transfer those to other people who do have tax liability. There's a film tax credit in 2012, about $300,000. That's another program where folks that generally make films sometimes do not have tax liability, and they, under the current code, they can transfer that to other folks who have tax liability. Solar energy credit was about $200,000 in 2012. The solar energy credit was terminated. There was an internal sunset date of July 1st, 2013, I believe, and that program was not renewed, so it has been terminated. And then there's a bunch of other little credits out there, but in some they total less than $100,000. One credit that West Virginia does not have is the earned income tax credit, and this map shows states that have earned income tax credits. These are the ones that have it against income tax. The state of Washington has an earned income tax credit, but it's not against income tax because they don't have an income tax. The states that are basically shaded with a pattern have a refundable credit, and the ones that are in red, Ohio and Virginia, West Virginia, as well as Delaware, do not have a refundable credit. You'll notice in terms of geography that for the most part, other than Maryland, the states around West Virginia do not have refundable earned income credits. Virginia and Ohio do have one. Pennsylvania and Kentucky have a low income credit, similar to West Virginia. And we take a look at some of the, and we're going to get into this more this afternoon, so this is just a quick overview. In 2012, nearly 160,000 returns claimed the credits, about 20% of all resident filers. This is at the federal level. The federal credit was worth over $340 million. 91.5% of it was refundable. That means that these folks didn't have any federal tax liability to begin with, and they got money back. Originally, the program was designed to offset my federal Social Security and Medicare taxes, but it was expanded a bit above that beginning in 1993. Positive benefits: it encourages employment for certain low-income workers, and it lowers the tax burden for those lower-income families. Of course, every tax credit benefit comes at a cost. The cost is there's higher marginal tax rates for those in the phase-out range. When you get above that certain level, those rates can be pretty high, and the cost has to be paid by somebody. Also, note from a purely an administrative standpoint, there are several publications out there, but there are significant non-compliance with the earned income tax credit at the federal level. So one of the risks when states tie into that is non-compliance that carries over to the state side. The interesting thing with earned income credit is that states with earned income credit tend to impose higher tax burdens on their lower income households than folks without the earned income credit. So ultimately, you impose high taxes on people below the poverty guideline, and then you impose an earned income credit to offset some of those high taxes. So even with the earned income credit, the state of Ohio has a higher tax burden on folks than West Virginia, as well as even the state of Virginia, a little higher than West Virginia. Certainly Maryland is higher than West Virginia, and West Virginia generally ranks in terms of equity. Of course, part of this has to do with the personal income tax itself. There's a group called the Institute for Taxation and Economic Policy that put this together, and they basically say every state is regressive, has a regressive tax structure, but West Virginia ranks the 10th least regressive among those who have a regressive tax structure, and we do not have the earned income credit. But ultimately, somebody has to pay for that earned income credit if it's to be instituted. Components of personal income tax, broken down as follows. Most of it is wage and salary income. That's in excess of 70% of the base. And that comes in as income withholding tax from employers. Estimated payments that are made by folks on income that's not withheld or if there are other adjustments. You get a pretty good number there, about 280 million. I didn't put the numbers in here. I'm wagering about $300 million a year. Non-resident withholding, that's withholding taxes on business entities that have non-resident partners. That's a rather successful program. It's about $100 million in revenue coming from that. And then returns and billings, that is billings that the tax department sends out as well as returns that folks file, brings in an additional amount of money. The amount that comes in on the returns and billings is very similar to the amount that goes out in refunds. So pretty good balance on that side. Local income taxes. Well, West Virginia does not have local income taxes. We have user fees, but not income taxes. Local income taxes across the country represent 4.3% of total local taxes. So that tells me that most local governments across the country do not rely on local income taxes. They rely on other types of taxes. However, West Virginia's contiguous neighbors account for 53% of the total. So most of the local income taxes are right around the state of West Virginia. And the biggest share is New York State, $8.7 billion, but that's for the most part New York City, which by some measures is a state unto itself. And the second biggest amount comes from the state of Ohio, nearly $4.4 billion. This is in 2012. Maryland, a similar amount, as well as the state of Pennsylvania, over $4.2 billion. The state of Indiana, $1.3 billion. State of Kentucky, $1.1 billion. And then everybody else is less than $1 billion. But the interesting thing, if you take a look at the local tax share of the total personal income tax imposed by those states, it's relatively high. So we must not ignore the local income tax when we think about how competitive West Virginia is versus other states. In Maryland, the local income tax accounts for 38% of the total state and local income tax. Ohio, 1/3. Pennsylvania, almost 30%, and Kentucky, 24%. Very significant taxes that they impose at the local level in those states. West Virginia and Virginia do not impose local personal income taxes. Now, I decided to look at some of the states that do not impose broad-based personal income taxes, and there's a total of 9 of them, and match them up against West Virginia, because ultimately all these states have to pay the bill somehow for government. And typically, and none of these variables are completely true for all states, but typically states without broad-based personal income tax impose higher than average property taxes. And that shows up in Alaska, as well as Florida and New Hampshire. South Dakota is above average. Texas certainly way above average. Washington way above average. The states also tend to have higher sales tax levies, and on a per capita basis, Wyoming is number 1. Their sales tax rate's only 43rd. What that means is Wyoming doesn't have many sales tax exemptions, but that means that they tax a lot of business purchases. That is, if you buy machinery or equipment for manufacturing, you're going to pay sales tax in Wyoming on those machinery and equipment. Of course, West Virginia would exempt those business purchases from taxation. Same thing is true in the state of Washington, where they have very high sales tax. The state of South Dakota has a very broad sales tax base that includes most services, such as legal services and accounting services. They rank 8th highest, and they have a higher than average per capita sales tax ratio. And then a number of these states also have what I call hybrid business taxes in lieu of the corporate income tax. In Nevada, they have a wage tax, which I would consider it's an employer wage tax imposed on the employers, sort of like an income tax, but we don't call it an income tax. And they're also migrating to what amounts to a gross receipts tax, although it's very controversial right now, just enacted. That when I look at that gross receipts tax, it looks an awful lot like our old B&O tax. In New Hampshire, they have a broad-based business profits tax that applies to both incorporated and unincorporated entities, as well as a business enterprise tax, which is an income value added tax. So it's basically a fairly broad tax, includes wages and salaries in there. That's virtually just like an income tax. Tennessee has both a corporate income tax and a franchise tax. We used to have a franchise tax. In Texas, they have something called a gross margins tax, which is broader based than a corporate income tax. In the state of Washington, they have what is called a B&O tax, which they copied from West Virginia many years ago. And then also, in terms of funding, sometimes you have to fund a little bit less on services. A few of these states rank near the bottom in terms of funding for K-12 education as a share of income, including Florida, Nevada, South Dakota, Tennessee, and Texas. Washington is below average. West Virginia, we're above average at 23rd on funding of K-12 education. That's just one of the variables. But ultimately, some other tax is going to have to fund in lieu of an income tax. And with that, if there's we'll take questions. And then I guess there's going to be a break at the corporate tax side. That's one here.